Hi guys, it's Sana and Mona Ali, the property twins here. I hope you are having a wonderful evening. Today, Mona and I wanted to talk about two things that people get horribly wrong with investing in property. So the first one is poorly structured finance, which means you haven't considered whether the property is your home for the long term or an investment for the long term, whether it should be principal and interest or interest only repayments. How should you factor in the tax effectiveness of that loan? What should be the loan term, for example, and what are the implications of the actions you take? And the second thing,
the second thing is really not doing the cash flows and being sold out on a brand new property, for example, and buying it just because you have the emotion into it. You put all your emotion into it, whereas buying an investment property is more of a numbers game. So, and you may buy something near where you live and in a particular postcode, and that's your key criteria, and you don't really do the numbers on that property. Or you might be sold out on the tax benefits, which should never really be the driver for you buying.
So two things: poorly structured finance and cash flow analysis. Not doing the cash flow analysis means most people are stuck at one or two properties even. And hi there, Joy. Hi there, Joy. How's it going? So in terms of looking at cash flow, when you look at cash flow, you need to look at, again, two things. The first is the initial outlay you're going to be having, the deposit you will be putting in, what the stamp duty for the purchase will be, solicitor costs, buyer's agency costs, and renovation costs. And deposit really is dependent on whether you're doing 12% or 20% or 10%.
Yeah. And in terms of cash flow analysis, Sana and I, we both put together a spreadsheet in our early days in our property journey, and we'd look at the income and the expenses side of it, which Sana will run through shortly. So we put together a spreadsheet where we pretty much run through every single deal. And some of the benefits that we found of doing that was, it gave us clarity on the rental return that was available to us, what sort of cash flow we were comfortable with on a weekly basis, monthly basis, and an annual basis. So if you'd like a copy of this spreadsheet, comment cash below. I did make a post on our page earlier about it, but again, if you'd like one, then just comment here and then I'll reach out to you for that.
Yeah, so the key thing in that spreadsheet, well, firstly, we started doing our numbers from day one. The day we decided we were going to purchase property, we started doing our numbers and analyzing every single deal that we have ever considered to add to our portfolio. So there's two types, as I said earlier, in terms of numbers: the deposit you're putting in, the stamp duty, the buyer's agency fee, any renovations that required, solicitor costs, and that forms the initial outlay for your purchase. And deposit could be anywhere like 5%, 10, 12, 20%. It really varies, person to person. So you really need to consider, because that will impact the bottom line of your purchase. And to do each deal's cash flow, you need to look at different things. Firstly, you need to look at the interest you'll be paying, whether you're paying principal and interest or interest only. Again, that impacts what your cash flow would be from your pocket versus the rent. The annual borrowing costs, the property management fees, there's council rates, water rates, landlord's insurance, building insurance. All those things really need to factor in your numbers. And you will find that even if certain properties are promoted as positive cash flow, they may not be when you actually do your numbers, right?
Oh, absolutely. And if anything, it would just give you a bottom line of what you are able to sustain, really. And early on in our journey, we realized what we were okay with and what we were not okay with, what sort of cash flows were acceptable to us. And another thing with interest repayments that you need to take into account, obviously that will be driven by what sort of deposit you're putting in, and whether you're doing a cash deposit or if you're doing an equity, your deposit or purchase costs are coming from equity that you've drawn down from your home.
Because it would be a drastically different number.
Absolutely, because using cash means really, you're not paying interest, so less cost and more positive cash flow. But when we sit down with clients, that's one of the key discussions we have, whether cash is the right way to go or whether it's equity, whether they should be using equity. So it's an important decision to make, because on paper it might look good. Oh, I want to put a cash deposit, it makes sense. However, it could have really significant tax implications down the track depending on your life circumstances. So all of that needs to be taken into account when making a decision.
And tax implications should be picked up when you're structuring your loan. So that comes even before you do the numbers for the deal, making sure it's structured properly so you maximize not just, the bottom line, but also long-term bottom line with the purchase.
Yep. So definitely consider, what loan to value ratio you should be doing and whether you are going to be paying LMI, because
and principal and interest.
And whether you'd be doing interest only or principal and interest, because that's going to impact your cash flows.
Yeah. And you should be looking at these numbers on in your spreadsheet weekly, monthly and annual basis. So you can really see a projection of how it will impact you and how it will fit in with your life circumstances. And eventually, once you've done a lot of numbers for a lot of deals, you'd really be able to look at a property on realestate.com.au and say, well, this doesn't fit my numbers. This doesn't meet my goal in terms of cash flow.
Yeah. And I'd like to add that, if you are putting in a less than 20% deposit, then you incur lender's mortgage insurance. And whilst, I no longer practice tax, but, if in case you didn't know, lender's mortgage insurance is a borrowing cost and it's tax deductible over a period of 5 years. So you do get some tax back on it. And in some instances, it may make sense to pay lender's mortgage insurance. So,
and don't just go by. There's a lot of developments that are being sold out there where they say, oh, you're positive cash flow by $50 a week. Really do your numbers, because again, depreciation rules have changed, and a brand new property doesn't necessarily mean you will have a better return. And especially because if you're reducing the income right now, or the return, you will be paying for it when you sell that property.
Yeah, and also another thing is really rental guarantees. I mean, that's for another topic altogether, but if there are rental guarantees, then you should do the cash flows based on what the actual market rent is of that property. Again, so we have a cash flow spreadsheet, so if you'd like a copy and see how we run our numbers or how our clients run their numbers, then put cash in comments below. And if you're watching a replay, then put cash in comments below, and then we'll reach out to you
so we can share it.
Absolutely. So, and if you'd like to obviously know more about this and how we work with our clients on it, then feel free to reach out through direct message.
Yeah, just send us a private message through Facebook if you'd like to know how we can help you as well structure that spreadsheet correctly, structure your deal properly and do the numbers correctly for the deals.
Yeah, because ultimately it's about building that property portfolio with a step-by-step strategy rather than using a dartboard approach, because too often...
And relying on someone else's numbers, right? $50 cash flow positive, whatever,
Yes. Have you done your due diligence? Have you checked it? So, and another thing is obviously keeping in mind the tax return will be subject to your own marginal tax rate. So just because, the advertising materials for a property say, oh, you're going to be having this much cash flow positive or tax returns, you need to really seek appropriate advice for that.
And do numbers for every single deal. It is initially hard to analyze, but once you see lots of deals, once you do numbers, you will get used to picking what the right deal is. And of course, put benchmarks on what is acceptable to you in terms of a deal. What may be okay, let's say $1,000 per month negative for one person, but another person might say, well, I can only do with maybe $200 negative a month cash flow. So it depends on every individual circumstances.
Yeah, and another tip I'd like to add while we're at it, talking about cash flows is, if you are reviewing a particular area and if you'd like to figure out what the cash flow is like there, then run through a number of deals and look at what's on realestate.com.au, what properties are on sale, and then look at similar properties which are advertised under the rental section and what those properties are renting for, and then run your numbers and say, well, if I bought this for this much and this was the hi Shafiq, hello. So what I was saying was, look at the rental return there, rental return, and then run the numbers for each deal, and then get a feel for what it's like. And
that should help you even nail down the area you want to invest in.
And could I please add a caveat that Sana and I, we are not buyer's agents. We are finance strategists who help our clients build multi-property portfolios through correct structuring of finance. And we just happen to be finance strategists and mortgage brokers who absolutely love property, and we love sharing in our knowledge and information with our clients and you all.
Yeah, so comment cash below or send us a private message and we'll be in touch with you for more information.
And even if you're watching a replay, then feel free to comment cash below and we'll chat very, very soon.
Thanks, guys.
Thank you.
Catch you
Bye.
later.
Bye.